Stay tuned for my CPI prediction towards the end of the video, and check out the link down below for the programs on building your wealth. Learn how to make more money as an entrepreneur, LLCs, insurances, or otherwise. Make more money as an employee, and learn how to become a millionaire through real estate investing in the Zero to Millionaire Real Estate Investing Program. Link down below. Learn property management, rental renovations, everything you need to know, and check out Stocks and Psychology of Money. All linked down below, which you can now use Buy Now, Pay Later for. We'll see you soon. I think the most important thing that we want to look at here is let's just talk about tomorrow. So most important, now obviously we've got green going into the market here on the eve of inflation. We've got Bitcoin over 30,000. In my opinion, the absolute most important thing coming up is the inflation report tomorrow. So let's just talk about my expectations around this inflation report, specifically what I'm looking for. And I'll put together all of sort of the research that we've been doing to put my thinking hat on and make a prediction here about inflation. So I want to be very crystal clear here. I think that inflation will end up proving to be longer term transitory. There's one thing everybody learned around this cycle, and it's patience. Everything took a lot longer than people thought. The Fed's hiking cycle came later than folks thought. It took longer than folks thought. Things started breaking, but quite frankly, the banking crisis and things started breaking really, in my opinion, aren't red flag that the Fed has over tightened or has created a recessionary environment. I think that the fringes suffer when there's a tightening cycle. The companies that are zombie companies with poor risk management procedures, the companies that have poor cash flow, the companies with exposure to risky assets like Silicon Valley Bank, startup sector, Signature Bank, the crypto sector, and Credit Suisse has been plagued with scandals and poor auditing and risk management procedures for decades. All of these companies collapsing really serves as no surprise, and in my opinion, not a sign of a greater financial crisis, but rather of a normal weeding out cycle that you would get in a crisis. That is normal. Companies that should not exist should die at some point. And that is what cycles do. The bear markets take out the bad, the junk. And it's like a hurricane that comes through and weeds all the trees. You know, after a hurricane, everything looks super clean around, with the exception of all the debris on the floor. But you look around, it's like, wow, everything feels like it just got a big bath. Everything just got blown around. I grew up in South Florida, so it's relatable to me. But anyway, point being, this recessionary environment could very much be like an economic hurricane where just the weak got cleared out and the excess labor got cleared out and they were encouraged to go be productive somewhere else. And we could end up coming out of this recessionary style environment with a substantially larger or more productive economy with higher GDP growth, which lowers the burden of our national debt anyway. And we could come out of this much more productive than when we went into this. In other words, all of this insane expansion of the money supply from the stimulus era could actually end up helping create this bubble environment where everybody got showered with money to go innovate and build and build and build. Then you run through and you basically destroy everything that couldn't figure out how to make it with unlimited amounts of money. So try making it with restricted money. And now, hopefully, going forward, you have the most efficient businesses left over that got stimulated massively and are still getting stimulated, whether it's chips, artificial intelligence, electric vehicles, energy, you name it. So regarding CPI tomorrow, and these, by the way, all my favorite pricing power stocks, my favorite stocks, you can see them, my actively managed ETF, the courses on building your wealth, everything. Just go to meetkevin.com. We've got a coupon code expiring tomorrow, and the price will be going up after April 12th. So CPI per Bloomberg, we know, is expected to come in at 0.2% on the month-over-month level, and the year-over-year level is expected to come in at 5.1%, which is fantastic. These are big moves to the downside from 6% to 5.1% from the prior read year-over-year. That's great. We don't get as much of a movement in core or when we exclude food and energy, so a lot of this being driven by a fall in food and energy prices. But if we look at the non-core, what we're really looking for is just starting signs of disinflation in services. That's exactly what Jerome Powell told us to pay attention to. He said, listen, goods deflation is here. That needs to hold. So we need to keep seeing weakness in used autos, new autos, durables, any kind of goods outside of foods and energy. Let's continue to see weakening there. Then At some point, we're going to get the rollover of housing data. That is, we will start getting weaker housing data for rents, and that will help lower owners' equivalent rents. That's part two. But part three, that doesn't have the forecast yet, that isn't expected just yet to roll over like housing or goods. Part three is that core services disinflation. Your attorneys, your financial advisors, your haircut, your medical supply or your medical services rather. All of these sectors are where we're looking for weakness. And Jerome Powell expects to see the process of, in his words, disinflation to begin there soon. My hope is we start seeing the beginning of disinflation there. Now, I think that inflation is going to just remarkably plummet and come in substantially low, and it'll all be over tomorrow. In other words, all the inflation will be gone tomorrow, and the Fed can finally start cutting interest rates more, much like the bond market anticipates. No, I do think, much like we saw last year, that the bond market is a little bit ambitious in their Fed rate cut cycle. Remember last year what happened? We were expecting at the end of last year that the Federal Reserve was going to cut somewhere between 1.5 to 2 percentage points by the end of 2023. Those expectations vanished very quickly. The reason those expectations vanished very quickly is because we had hot January numbers. And all of a sudden, we went from pricing in rate cuts to pricing in no rate cuts. But what interestingly happened is the stock market actually rallied substantially in the first 3 months of the year. So, is it possible that that same thing could happen again? My thesis is yes. We could start seeing disinflation on the services side. We're clearly on the path towards disinflation. However, we're not in as bad of a recessionary environment thanks to the banking crisis as people expect. As a result, what happens? We have to start pricing in higher interest rates for longer. But the last time we did that, between December and about February, stocks actually rallied. Now, it's possible that they rallied because of tax loss harvesting and rebuying in January. But take a look at this particular chart. This shows us the current implied overnight rates and rate cuts. And what we're seeing is this plummeting. In other words, we'll get to a terminal of about 5.25 with about a 65% chance by June 14th. And then we expect to see this plummeting in rates where we could potentially be cutting rates as much as 2.75% as soon as January 2024 and the December cycle or December meeting in 2023. That's entirely possible. But I think personally it's unlikely we're going to see cuts that dramatic unless, of course, the economy is absolutely going into a recession. Based on the Atlanta GDP Now forecast, GDP today could still be around 2.1%. And if that holds even above 0.5% through this summer, this scary Q2, Q3 era that people are really worried about, then it's entirely possible that we could see inflation continue to trend down while stocks continue to trend up. And we price in higher for longer. Now, that is what many people call a Goldilocks scenario. And I think they use that because they're trying to say it's unrealistic. It's not going to happen. It's very unlikely. But let's think about this graphically for a moment, how this could look. And then we'll also combine real estate. So let's look at this graphically for a moment. So what do we have? We're over here in December of 2022, and we think that rates are going to be lower. So we price in lower rates, right? What happens come about January and February? Well, we start pricing in higher rates. Then we get the banking crisis. And what do we get with the banking crisis over in March? Well, we start pricing in lower rates for that December era of 2023. So let's go ahead and write December over here. March, the banking crisis happens, so we get higher for longer. Up here, this will be our rates for green here. And now we're pricing in lower again, right? This is going to be what is being priced in. Rates, or let's write in, we'll say rates now for 411. But let's do a rates likely trajectory. And this is going to be sort of more of what I believe in terms of the trajectory. So we'll go ahead and follow the light green over here. We'll get our 5.25, but we potentially stay there at a pause for longer. This is that higher for longer argument, right? And the reason I think that maybe we don't actually end up getting any kind of cut until, let's say, September, and we sit at this pause level for longer, is because we know the Federal Reserve does not want to make the same mistake that they made in none other than the 1970s. In the 1970s, the Fed took this approach of start, stop with rates, and that ended up being a big mistake because it broke inflation expectations. Because inflation expectations have been so incredibly anchored over this entire cycle, I personally think it's highly likely that we're going to have a pause for much longer than markets are anticipating. Now, what does that mean potentially for the stock market? Well, I think a pause for longer is actually a good thing. You still get your sort of the Fed suggesting, hey, we're conquering inflation, we're going to pause. So you get the benefit. What does this do? It creates we'll put benefits. It creates the benefit of we didn't break everything, so didn't over tighten, right? Benefits of pause for longer. That's what I'm calling it. The benefits of a pause for longer. We didn't break everything. We didn't over tighten, which Jay Powell says, hey, there's no evidence that we've over tightened, which I would argue differently that there are some evidences that we've over tightened. But anyway, benefits of pause for longer. We didn't break everything. We don't repeat the mistakes of the 70s that created hyperinflation. But in addition to that benefit, we can support a Nike swoosh stock market. Now, why is that? Well, first of all, it is what has been happening. As interest rates were actually projected to go up, what happened? Well, the stock market actually also went up. And even though we've been somewhat volatile over here, we've been somewhat stable. And so the Nike swoosh thesis, if we kind of draw the Nike swoosh as sort of a big down and then a big trend channel up with a lot of volatility in it, we could see our Nike swoosh, this Nike swoosh expecting to take potentially 10 years as we start our next bull run. Now, what does that potentially mean for real estate? Well, real estate is probably the biggest outlier right now. We really don't know. And that's because even though Treasury yields have come down, spreads on mortgages have gone up. So mortgages are still pretty expensive. And right now, because there's such a lack of inventory, you're actually seeing prices in many markets start rising year over year again, and they're escaping that potential year over year negativity that we would have expected for next month. May had prices even just stayed level. We're actually starting to see those move up. Now, that could turn upside down. In other words, real estate could get hit substantially harder in the event inventory skyrockets as REITs start liquidating or professional institutional investors start liquidating. I think it's unlikely that any kind of liquidations are going to come from regular households via short sales or foreclosures or whatever. So instead, I think it's likely that the stock market continues its sort of Nike swoosh on trend up. We have this higher for longer regime in the stock market, right? And this is Kevin's crystal ball. But I do think that this takes a lot longer to rotate down. I think the Fed is going to be okay with slightly higher inflation for longer, via no wage price spiral. That we already know the conditions of that are not present. We know that very clearly looking at almost any earnings call from the last 3 to 6 months of companies who employ or hire labor. But also the principle of flexible average inflation targeting, which would suggest that the Fed is okay with a higher inflation rate for longer because as long as it averages 2% over the long term, they're okay with that. And they can take opportunistic inflation to get there rather than breaking markets. So what you have here is this combination of, I think the bond market is a little enthusiastic, assuming that we're going into this deep, dark recession. I think that upper end consumers still have plenty of money to spend and probably will for another year. But by that time, we should be convinced that inflation is actually lower, which might loosen banking standards again as rates slowly start coming down. So I think the loosening of banking standards comes when inflation is convincingly down, right? And then that's actually where we cut. When the Fed cuts, it's a huge indicator this cycle that they've won on inflation. The Fed winning on inflation is everything here, folks. This is not the Fed cutting because they care about recession or not. They will gladly force us into a recession if they need to. What the Fed cares about is conquering inflation. And that's, I think, why we end up with a pause for a lot longer before we start getting cuts. I think the bond market is being a little excited, anticipating as many cuts. Now, what I do think, if I were to draw in real estate here, this is going to be a little bit trickier, but let's try to make a projection here with real estate. So I think that real estate prices stayed higher for longer. I think we had our adjustment down in real estate, about 10%, 20% in some areas. You're starting to see this right now where you're trending up. In Florida, for example, you're actually positive. So you're starting to see a trend up. The only way you could really push that down is if you get substantial inventory increases, which so far we're not seeing. But people right now seem to be comfortable with these higher rates, and it's leading to more of a soft appreciating market. Now, if we then, as interest rates potentially start coming down, the traditional argument is that, okay, well, rates are starting to come down as the Fed cuts. The traditional argument is, oh, great, well, that means raise prices are going to go up again, right? Not necessarily. What is actually entirely possible with real estate is that as rates come down, more people decide to sell. People who've been locked in and they didn't want to take a high 7% loan or whatever. And you actually keep this pressure down on real estate, where as you're increasing inventory and as rates are coming down, you're actually just staying stable. And I actually think this is going to create a wonderful window of opportunity to buy. I don't think you necessarily have to try to time here, or if we end up getting any kind of like little bit of a dip again over here, I don't think you have to be perfect on that. I think as an investor, you want to look at this future over here. And there are two main investments that you want to be making right now. Well, maybe not necessarily immediately right now for real estate, but soon you want to be getting into real estate. Obviously, I have a course on teaching you exactly how to go from zero to millionaire through real estate investing. And I think this flat period of time we might face, or even a slight dip again, we don't know. It's going to be one of those, I think. Although it's also possible that real estate just goes to the moon again as the money printer is turned on. Though I think that's less likely. I think first we go through some form of inventory shock, which either drives prices down more or it just levels them out, right? And that will create a beautiful window of opportunity, which we'll have more insight on by the third quarter. That's when I expect to start buying for my real estate startup. So I think by the third quarter, we start having some nice opportunities to really start buying in sort of this flatter market for longer. At the same time, and in the meantime, hopping onto this Nike swoosh recovery of the stock market, trending up as inflation proves to go away. So this is a pretty detailed, in my opinion, thesis going forward. Now, what are the risk factors here? The risk factors that would encourage you to get life insurance in as little as 5 minutes by going to kevin.com/life. All right, risk factors. Remember, none of this is financial advice. It's non-personal financial advice. I am a licensed financial advisor, but I don't know you, so I can't give you personal financial advice. So when I say I think it makes sense to go long stocks, which I've been saying for a while now, and soon it's going to make sense to really go long real estate and then acquire as much assets as you can over this next decade, that's not personalized financial advice. I just think it's good financial advice, broad, generic financial advice, right? I think everybody should be doing that. So what are the risk factors here? Well, obviously, the risk factor is that if we have sticky inflation, which we'll see more about tomorrow, if we have sticky inflation on services, then expectations on inflation could unanchor, and we end up getting Paul Volckered, right? And then what you have is the worst case scenario. Worst case. There we go. So that's the worst case scenario, is we get Paul Volcker. That's deep, dark, dirty recession, right? This would be very bad. It's entirely possible that this could happen. I would put about a 5% risk on this. I think you're 5% looking at Paul Volcker, and I think you're probably more like a 20% recession for longer. So I would call it like a shallow, low growth recession for longer. Ironically, a low growth recession actually leads to a flight towards growth stocks like big tech, safe growth stocks, safe ones. So I think that's why you're not seeing as much of a sell-off on some of the mega cap names. We know that yesterday Apple had a pretty big hit in terms of their numbers for PC shipments, Mac shipments, but the darn thing's down like 1.5% to 2%, so not that big of a deal. The stock market is rotating down at the time of recording this video, and I think a lot of that will be in anticipation of CPI tomorrow. So I wouldn't judge the content in this video by stock market performance today. I would go into CPI data tomorrow and see, does this make sense? Is it possible that we could actually end up with the benefits of pause for longer and disinflation, leading to great opportunities for us to buy in the Nike swoosh and in the real estate flatness, while at the same time recognizing that, yes, there are risks of Paul Volcker, but they seem far-fetched. In other words, I think it's also worth noting that any kind of de-dollarization, if you've watched any of my videos on the dollar of the past 3 weeks here, I think this is also a far-fetched idea. I think war with Taiwan is far-fetched. So I think these are risks that are less likely, in my opinion. They do have some merit, though. So we'll see. This is in my opinion something that is sort of an investing outlook. And now within this scope, we could explore or companies within that scope. So that's my thesis on what's going on in markets. So hopefully that is helpful to you. Make sure to check out those programs on Building Your Wealth link down below. Hopping over to the course member live stream now. Appreciate y'all being here. Another Me Kevin report, and we'll see you in the next one. And now for my CPI prediction, I believe that a CPI month over month headline will actually come in low at 0.1%, which would be fantastic. I also believe that core will come in, and instead of 0.4, it will come in at 0.3. So just nominally a little smidgen below on both of the month-over-month figures. Again, the expectation is 0.2 and 0.4. I'm at 0.1 and 0.3. That's my take. I think the banking crisis is going to have kind of basically moved these estimates a whole notch lower by about 0.1%. I think there was a lot of, in March, and that's part of my basis in addition to the research that we're doing. I don't think that we're going to get a miss to the upside. I think that's substantially less likely than just a match. So I'm going to go probably 65% chance, 0.1 and 0.3 for the core. The base case would be, well, I guess I wouldn't call it the base case because my base case is coming in low, but the market's base case is 0.2 and 0.4. I would put that at maybe a 30% chance, and then maybe a 5% chance we get something hot. So I don't see hot after that banking crisis. I could be wrong, though, and I will experience being wrong with you tomorrow if I'm wrong. And if I'm right, I'm right. So I'm optimistic, we'll put it that way. See you soon. And now my CPI prediction. My CPI prediction is based on the shock of, well, the banking crisis in March. And I actually think we hit a little bit of more of a wall than economists are actually projecting. Economists are projecting 0.2 month over month and core 0.4. I think each of these will come in low by 0.1%. I think we will be coming in at a CPI month over month of 0.1. I only align with about 4 out of about 63 economists surveyed by Bloomberg on this. So I'm super on the left edge of this. Now, when it comes to the right edge, in other words, this coming in hot, I think that's very unlikely. I think there's probably a 60% chance we come in low, 0.1% CPI month over month, 60% chance we come in at 0.3 on the CPI core month over month. I think it's more of like a 35% likelihood that we come in at expectations, which would be 0.2% month over month, 0.4% month over month core, and then only like a 5% chance that we come in above. That's my take. It could end up being wrong. If I'm wrong, we'll be wrong together, but that's my belief, and I'm sticking to it. I think the Nike swoosh is holding. I think we are going to start seeing at least some early indicators of services disinflation. No signs that inflation is rebounding. That's what we're looking for. So hopefully, fingers crossed, we'll see you tomorrow morning at 5:30 a.m. Pacific time, 8:30 a.m. Standard Eastern time. Eastern time, not Standard time. I guess Eastern Standard time. Whatever. Eastern time. We'll see you then there. Bye.